Most couples have never even heard of this strategy, but it can help you retire earlier, save tax, and boost your age pension. And the best part is not about contributing more, it's about being smarter with what you already have. In this video, I'll show you how contribution splitting works and why it's such a game changer. I promise once you understand it, it changes how you play the super game. Let's start with what contribution splitting actually is. It's a strategy that allows you to transfer part of your super contributions into your spouse's super account. Let's break this down. You can only split concessional contributions, which include superannuation guarantee contributions, salary sacrifice, and any personal contributions for which you claim a tax deduction. You can split up to 85% of these contributions. For the purpose of this strategy, the definition of spouse includes a person of any gender that fits any of these three categories. And remember, this is different from making a direct contribution into your spouse's super. It's about transferring part of what's already been contributed into your own super account across to your spouse's super account. For example, let's say we have a couple, John and Emily. In FY25, John earned $200,000. His employer contributed $23,000 to his super. He also salary sacrificed $5,000 and made a $2,000 personal deductible contribution, bringing his total concessional contributions to $30,000. John can choose to split up to 85% of that, $25,500, into Emily's super account. Now that you understand the basic mechanics, let's dive into the nitty-gritty details, like who is eligible, when you can apply, what the application process is, how the contribution caps work, and how this strategy can be combined with the carry-forward concessional contribution rule. Who is eligible? To use this strategy, there are no age or work requirements for the contributing spouse. However, at the time the split request is made, the receiving spouse must meet one of the following conditions: be under the preservation age, or be between their preservation age and 65 and not retired. When it comes to timing of the application to split, there are two key points and one exception. First, you can only apply for contribution splitting once per financial year. Second, you can only split concessional contributions from the previous financial year. For example, if you are applying in FY25, you can only split the concessional contributions made in FY24, not any earlier years. To split your FY25 contributions, you will need to wait and apply in FY26. This is a standard process unless you qualify for an exception. The exception being if you are effectively closing your super account before the end of the current financial year, you can apply to split contributions from both the previous year and the current year in a single application before the account is closed. There are a few reasons someone might close their super account. This could include rolling over to another super fund, starting a pension account, withdrawing their super benefits, or a combination of these actions. What is the application process? First, check if your super fund actually allows contribution splitting. Not all funds offer this option. It's voluntary for the fund trustee to provide this service, and it's only available if you have an accumulation account. If your fund does allow it, the next step is to confirm which form to use. Some funds accept the standard ATO form, while others require you to use their own version, often with additional requirements. For example, if you're with Australian Super, you must use their specific form, not the ATO's, and follow their additional instructions. Once you confirm the process, the rest is fairly straightforward. You will need to provide both you and your spouse personal and super account details and specify the amount you want to split. How does the contribution caps work? Even though contribution splitting moves money into the receiving spouse super account, the full amount still counts against the contributing spouse concessional contribution cap for the financial year. Splitting doesn't create extra contribution room for the contributing spouse. the amount transferred becomes part of the receiving spouse taxable component and is included in their total super balance. Can you split a larger carry-forward concessional contribution? Absolutely. Let's look at an example of how combining carry-forward concessional contribution rules with contribution splitting can create a powerful result. Daniel is self-employed, and over the past 5 financial years, from FY20 to FY24, he made $10,000 in personal deductible contributions to his super fund each year. He didn't use up his concessional cap in any of those years, so the unused cap amount have carried forward. As of 30th of June 2024, Daniel's total super balance is below $500,000, which means he is eligible to use the carry forward concessional contributions rule in FY25. In FY25, Daniel's available concessional contribution cap is $112,500. That includes the standard $30,000 cap for FY25, plus $82,500 in unused caps from the 5 prior years. Daniel receives the inheritance and decides to contribute the full $112,500 as a personal deductible contribution to super. He submits a valid notice of intent to claim the tax deduction and receives acknowledgement from his super fund. Then in FY26, Daniel submits a contribution split application to move 85% of that amount, $95,625, into his spouse Jen's super fund. His fund accepts the application and the full $95,625 is transferred to Jen's super account. That's a significant amount, far more than he could have split if he hadn't used the carry forward contribution rule. By now, you can probably see, using the super contribution splitting strategy, whether as a one-off or ongoing basis, can significantly affect how super balances are distributed between 2 people in a couple. And that balanced distribution is something we can strategically influence to unlock a range of benefits. First, if there is a significant age gap and the receiving spouse is older, transferring super to them can give the couple earlier access to retirement savings, since that older spouse will reach preservation age sooner. Second, if the older spouse is approaching age pension age, shifting more super into the younger spouse accumulation account can help reduce accessible assets for Centrelink, potentially boosting their age pension entitlements. Third, if one spouse super is approaching the transfer balance cap, which is $1.9 million in FY25, $2 million in FY26, contribution splitting can help avoid exceeding the cap. Going over the cap means paying tax on earnings from the excess amount, so shifting some of the super into the other spouse account can help minimize tax and maximize overall retirement savings. Those 3 reasons are just some of the most common ways couples use contribution splitting. There are other use cases as well. I'll walk you through detailed case studies to demonstrate each of them in the upcoming videos. So if you're looking to get more out of your super as a couple, make sure you subscribe and stay tuned. Thanks for watching. I'll see you in the next one.